Imagine checking your phone in the morning and seeing an extra $3,300 quietly deposited into your account without lifting a finger. No boss, no side hustle, no overtime, just your money working harder than you ever could. That's the strength of dividends. And while it may sound like a financial fantasy, the truth is it's a reality you can start building today. We're going to follow John, a regular guy who decided he was done living paycheck to paycheck. He set one clear goal: earn $3,300 a month in passive dividend income. That's $39,600 a year. And you'll see exactly how he did it. We're going to break down how much money he needed to invest, the 3 strategies he used, and the real stocks that helped him reach that goal faster. Now here's something to think about. How much would you need to replace your income with dividends? Is it really millions of dollars like most people think, or could it be less if you follow a smarter plan? That's what we're diving into today. 3 beginner-friendly strategies that'll help you live off dividends. Whether you're starting from scratch or already investing, this will help you move forward with more clarity. So let's start where John began, with a simple question. What are dividends, and how do they actually work? Let's take this as an example. When you buy a share of a company, you become a part owner of that company. Nothing fancy, just a small piece of a big pie. Now, when that company makes money, real profit, it can do a few things with that money. It can grow the business, save for a rainy day, or it might decide to share a portion of those profits with its owners. And since you are a shareholder, you are now one of those owners. That shared profit is called a dividend. Now, how you receive that dividend can vary. Sometimes it shows up as cash, either digitally deposited or even by check. Other times, you might choose to reinvest that cash to buy more shares. It's like taking your earnings and doubling down on the same investment. Over time, this reinvestment can really snowball thanks to compounding. Most companies follow a fixed schedule. Some pay quarterly, others monthly. A few do it annually. But for someone like John, who's planning his budget around these payments, knowing the timing matters. It's a small detail that makes a big difference when you're trying to live off of that income. One term that really stands out is dividend yield. It's just a way to measure how much income you're getting from the stock compared to its price. Say a stock is priced at $100 and pays $10 a year. That's a 10% yield. Simple, but incredibly useful. It helps you compare different investment options and understand what kind of return you can expect and what amount you need to invest. A higher yield means more income, but it doesn't always mean better. You'll learn quickly that some of the highest yielding stocks also carry more risk. So the plan is simple. Choose reliable dividend payers with yields that make sense for your goals, enough to generate real income without gambling on unstable companies. And now, with that foundation in place, John was ready to take the first big step. He wanted speed, the fastest possible way to hit $3,300 a month. That's when he discovered covered call ETFs. One of the fastest ways to start living off dividends is by using something called covered call ETFs. These are special types of funds that let you earn income from 2 sources: the stock they hold and the extra cash they generate from options. It sounds complicated, but it's actually pretty straightforward. Here's how it works. The ETF owns a bunch of stocks, but it also sells call options on those same stocks. And a call option gives someone else the right, but not the obligation, to buy a stock at a certain price within a certain time frame. When the ETF sells those options, it collects a fee called a premium. That premium becomes income and it gets passed on to you as part of the ETF's dividend. John started exploring some of the top options, and here's what he found. QYLD with a yield of 13.17%. XYLD yielding 13.14%, and then he found TSLY, the Yield Max Tesla ETF, with a jaw-dropping 95.41% dividend yield. Yeah, that last one definitely stands out, but more on that in a second. The first two, QYLD and XYLD, offer strong, steady yields. Both are paying right around 13% annually. So let's run the numbers. John's goal is $3,300 per month, which equals $39,600 per year. To figure out how much he needs to invest, we just take his income goal and divide it by the dividend yield. With QYLD at 13.17%, the math looks like this: $39,600 divided by 0.1317, about $300,838. With XYLD at 13.4%, the math is almost identical: $39,600 divided by 0.1314, about $301,368. So in both cases, John would need right around $300,000 to $305,000 invested to generate the $3,300 monthly income he's aiming for. To be a little conservative, we can round that up and say roughly $330,000 would comfortably cover it. But then John saw TSLY, and that yield of 95.41% caught his attention instantly, as I'm sure it did yours. Based on that yield, he could hit his $3,300 per month income goal with an investment of just around $41,500. On paper, it looked like a shortcut to financial freedom. Think about that for a second. With QYLD and XYLD, John needed about $300,000 invested. But with TSLY, he could technically hit the same monthly income target with less than $42,000 invested. As I said, on paper, it looks like a shortcut to financial freedom, but John knew better than to jump in without understanding the full picture. TSLY isn't your typical ETF. It focuses entirely on Tesla stock and uses a more aggressive option strategy to maximize income. That's why the yield is so high, but it's also why the risk is higher as well. If Tesla's price drops significantly, the fund's value and the dividend could be impacted. And because of the option strategy it uses, the potential gains are capped. So if Tesla's stock shoots up, TSLY doesn't fully capture that upside. So while TSLY technically could help John hit his income target with far less capital, it might not offer the consistency or long-term reliability he was really looking for. Still, the idea of getting paid every month just for holding these funds felt like a real breakthrough. It showed him that building a paycheck without the job wasn't just possible, it was already within reach. With that first strategy in place, John turned his attention to another path. This one wasn't based on stock options, but something much more familiar: real estate. That's where REITs come into play. REITs are companies that own or finance income-producing properties like storage units, apartment complexes, office buildings, and even shopping centers. These companies collect rent, manage tenants, and do all the heavy lifting, and then they pass along a portion of their profits to shareholders like John. It's like becoming a landlord, but without the 2 a.m. phone calls or clogged toilets. And here's the interesting part. By law, most REITs are required to pay out at least 90% of their taxable income as dividends. That makes them one of the most consistent and generous sources of passive income on the market. So John started digging into the REIT world and found some names that stood out. First was Cube, or CubeSmart. They operate storage facilities, a business that tends to do well in both good and bad economies. Their current dividend yield is 5.21%, not sky high, but pretty solid considering the stability behind it. Next up, NSA, National Storage Affiliates, another storage REIT but with broader exposure and a slightly higher yield of 7.63%. And finally, Loan, better known as Manhattan Bridge Capital. This one's a bit different. It focuses on short-term, high-interest real estate loans. It's more niche, more specialized, and it comes with a higher dividend yield of 8.61%. With that higher yield comes higher risk, but John saw the potential for boosting his overall income mix. On average, these three gave him a blended yield of about 7.15%. So to hit his $3,300 per month goal, or $39,600 a year, John would need to invest around $554,545. It's more than the covered call ETFs required, but it's something tangible. Behind every stock symbol, there's something real: a building, a lease, a tenant. There was also the benefit of monthly dividends. Not all REITs pay monthly, but many do, which fits perfectly with someone trying to replace their monthly paycheck. It makes budgeting easier and creates a steady rhythm of income. Of course, John also understood the risks. If the real estate market takes a hit or if rental demands drop, REITs can feel the pressure. That's why he knew it was important to research each REIT carefully, looking at factors like occupancy rates, debt levels, and how well the business is run. To play it smart, you have to think about spreading your investment across a few different REITs instead of going all in on one. That way, if one struggles, the others can help balance things out. REITs became John's second strategy, a little more traditional, a little more stable, but still strong enough when structured the right way. But John wasn't done yet. There was still one more strategy he wanted to try, one built on reliability, long-term growth, a track record of increasing income, and most importantly, the safest option of the bunch. And that brought him to the world of dividend aristocrats. Now, dividend aristocrats aren't just any type of dividend stock. To earn that title, a company must be part of the S&P 500 and must have increased its dividend payout for at least 25 years in a row. No breaks, no excuses. That includes times of recession, crisis, and chaos. So when John learned this, it immediately caught his attention. These aren't flashy companies, they're steady, consistent, and built like financial tanks. John thought of them like the blue-chip backbones of a dividend portfolio. So he started looking at a few well-known names. First on his list was PepsiCo. It's been paying and increasing dividends for decades, and it currently offers a 4.04% yield. The company sells more than just soda. Its reach includes snacks, water, sports drinks, brands that stay relevant no matter what the economy is doing. Next, he looked at Hormel Foods. With a 4.68% yield, it's another quiet powerhouse. Known for long-standing products and a conservative business model, Hormel has a long track record of stability and dividend growth. It's not the kind of stock that makes headlines, but it delivers strongly. Lastly, he found AbbVie. It had a slightly lower yield of 2.93%, but its history of strong earnings, healthcare focus, and consistent dividend hikes made it a worthy candidate for the group. Plus, it added a bit of sector diversity to John's plan. Altogether, these stocks gave John an average dividend yield of around 3.88%. To reach his goal of $3,300 per month or $39,600 a year, he'd need to invest about $1,020,619. That was a bigger number than the other strategies, but still far less than the traditional index funds for which you need more than $2 million. So while the upfront investment needed is higher among the three strategies, the trade-off of stability makes it worth it for investors who want to feel safe. Want to know which 50/50 ETF combo has crushed the S&P 500 for 10 straight years? Click the video on the screen to find out.